let's please lower our expectations about BEPS. BEPS is not and was never intended to be a framework for global tax reform. It is really a fight between the United States and Europe about whether US multinationals are going to pay income tax to Europe. That's what it's about. It is, the project itself, all those 15 points, is designed to patch up the current system. And yes, patch up separate company accounting without admitting that it's the problem. I'm as against it as you are. Financial accounting does not recognize it. You know, it will die. It's not going to die in this project, okay? This project isn't about developing countries. You know, it isn't even really about the United States. It's about Europe. It's about whether these companies are going to pay taxes to some of these countries. Now, ultimately, what's at stake here? These countries don't issue their own currency. They're on the euro. The euro is like the gold standard after World War I. All these countries here, this is Club Med, okay? They're insolvent. The euro problem gets here, to France. The European Union is dead. They have bet the European Union itself, and it was the European Union is a good idea. They betted on the currency. And the currency rules say that you gotta have a budget deficit of no more than 3% of gross domestic product, which is very hard even in good times. It's darn near impossible if you are not printing your own currency and you have heavy social spending and you have a lot of individual tax evasion and you have corporate income tax as a really tiny percentage of your receipts. In Europe, corporate income tax is a lot less than value-added tax. So what you're seeing, and the reason you're seeing the corporate tax effort in parallel with the individual, you know, tax evasion stuff and the bank haven stuff, is because these countries have to get every centime they can in not their own currency to get their budgets balanced to stay in the euro. And yes, Europe, you want to talk about democratic non-accountability? Europe is being run by bankers and technocrats now. No, come on, I don't have very much time, okay? I really don't. I got about 30 little things to go through. I have no time, okay? Europe's being run by bankers and technocrats. So let's get over to when we get over to the BEPS project, which really has nothing to do with developing countries, it doesn't mean there's not some meaningful stuff in there that developing countries can look at and use. Country-by-country reporting, you know, folks are lucky that that got anywhere because the United States opposes it and the multinationals oppose it. They've whittled it down to a very small thing. But what's going to happen is the countries that receive this information are going to be dissatisfied and they'll start asking for more, and you sort of have to wait for that to happen. Another little item in this 15, there is supposed to be a multilateral convention that will automatically update all the OECD model treaties, which sounds like a very technical thing. But if you are a developing country and you are stuck with some of these OECD model treaties, you want to sign that update, okay? Because they are going to tighten the rules. Now, we're still talking within the existing unsatisfactory rubric and trying to improve it, and ultimately that will fail, but, you know, we got to wait 10, 20 years for it to fail. In the meantime, signing that thing is not a bad idea. Another thing that's in there, and it's in there as a giveaway to companies to keep them happy, is the OECD is looking for more mandatory arbitration clauses in treaties. Now, no developing country should sign a mandatory arbitration clause in any contract of any kind. So you have to keep an eye on that one and resist that one, because the companies are jumping up and down going, oh, we must have mandatory arbitration of everything. And we all know mandatory arbitration is secret and horrible. Now, tax competition, we're going to put the UK up here, and we're going to put You can tell I went to American public schools and that my geography is weak, although I did a really good job in Italy. Okay, the United Kingdom has turned itself into a tax haven. Ireland is already a tax haven. Ireland is on the euro. Both of them are EU members, okay? There is a tax competition item in the BEPS project. All it's really about is beating the patent boxes that you have. Let me get the Netherlands in here. The patent boxes that you have in some of these countries. It's not going to get to stuff like Ireland's low rates. Okay? Not in this project. Now, Ireland's low rates are endangered by the fact that Ireland, which is sort of an honorary member of Club Med, even though it's not Mediterranean, needs another bank bailout. And in the last bank bailout, those rates were on the table. And the Irish refused to raise them. Eventually, the Irish will be forced to raise them, but that's not going to be a BEPS thing, that's a banker thing. But it'll happen eventually, but that's another thing you have to wait about. Don't expect a lot on tax competition in this report. Now, let's get over to some more technical things that developing countries can look to. One of the ways to get money out of market countries is to pay interest to yourself. And you put your little group finance company in tax haven, and there's lots of them that are willing to house them. And you have your affiliates pay deductible interest. Germany has very tough rules, and you can't fool around with them. 30% of earnings before interest, depreciation, and taxes. That's all the interest you can deduct. You cannot wipe out your income paying yourself interest. You can do that in the United States. European multinationals don't pay tax in the United States. And they're not gonna, ever. Because we don't, because what they do is they build car plants in the southern states with no unions. And then they tell the United States government, which is right back here, that they hire people and they can wash out their income paying themselves interest. So that's a very common technique. It's easy to address. What's going to happen in this BEPS project is they will come up with a recommendation that kind of looks like the German rules. But other countries like Italy are already copying the German rules. It's called the interest barrier rule. And so if you're a developing country, yeah, you want to get a set of rules like that in place. That's not a hard one. Hybrids. You mentioned the hybrid thing. That's another payment thing. Basically what that says is, well, you paid the thing out as interest, and then when it got here, it was considered a dividend, and it was excluded because European rules say you have to give a dividend exclusion. So you got a deduction here, and you got an exclusion here when you paid it to your Dutch holding company, and that means you got a double dip. European countries aren't real happy about that. There are Danish rules where they basically say, no, we're going to treat this the way you treated it over here, and you don't get the double dip. There's a set of hybrid rules in a report that the BEPS project, drafters have put out. It's a pretty good report. What that says is, if you're a developing country, you got to get some anti-hybrid rules in place. Because the United States is the font of hybrids. U.S. corporations can use hybrids like nobody's business because they're allowed to have these tax nothings, and they're allowed to make the income disappear from our CFC rules. And the United States is not going to claw back on any of that. So that means all these other countries have to have anti-hybrid rules. Next thing, this is the big one, intangibles. Intellectual property. United States companies develop it, okay? They stick it in the islands, okay? They stick it in Switzerland. They could even stick it in the United Kingdom with the patent box. U.S. rules allowed that, and a lot of the valuable intangible property of big-name U.S. companies, big-name consumer products companies, is already in these places. So here's the game. What the companies are doing is they're, rooting the income out of market countries into there and saying, well, no, we don't have to pay any tax on it anywhere. That's a rough approximation. It will take all day to explain the steps. What the fight is about with the, yes, okay, fine. with the BEPS is, are they going to be allowed to book all this income in here? And what India would say is, well, you know what? You know, you're selling here. We think you ought to be paying tax here. And the Chinese will say, you know what? You're manufacturing here. We think you ought to be paying tax on the use of that intellectual property here. And what the Europeans are sort of saying is they're sort of saying you're selling here, but they don't want to go all the way with that. Because we'll get their companies in trouble when they're selling in China. And what the United States is saying is, oh, well, you know, you get to put some money in Bermuda, but if anybody's going to tax that, it's going to be us. But we know that the United States is not serious about taxing its big companies. And neither of these guys, push comes to shove. You gotta face this whole thing with the attitude that none of the home countries of multinationals are going to tax them. So then what you have to start thinking about, and the Indians are already way ahead on that, and this is where the new ideas are coming from, India and the US states, is eventually where you want to get is formulary apportionment based on sales, okay? Now that means ignoring separate companies, that means ignoring silly rules like permanent establishment that we talked about yesterday, that means upending a lot of this system. It is kind of very slowly, gradually happening, and folks have to be patient about it, and folks have to allow this BEPS project to be tried and fail, and then pick up the good ideas that come out of it. Because, you know, developing countries are in a position of having to cope with this stuff while it's still in place, and while they have still signed OECD model treaties. You know, you can always rip those up. Now, getting back, yeah, okay, so I've come full circle here because, you know, when we talk about digital economy, you know, we talk about selling into a place with no presence. Okay, here I'm going to draw New York State. New York State, just change its law. You do $1 million of business in New York State, corporate income tax there. No presence, no people, no factories, no warehouses, no nothing. $1 million of sales, corporate income tax. In the state parlance, that's called economic nexus. In international parlance, it's called service PE. India has service PE in some of its treaties. It's happening, and it's happening in a very subtle, slow way. I mean, a couple of years ago, and I'm going to finish up here, the OECD itself was forced to say, and this is going to sound like a picky little technical point, but this is a big, you have to understand that the BEPS report is a big admission against interest, as the lawyers would say, and I am a lawyer, and you do need tax professionals to help you with this stuff. The BEPS report is a big admission against interest for those folks because they basically admit, yes, we've been enabling multinationals to zero out, and that was our mission to make life comfortable for them, but not this comfortable. Another big admission was a couple of years ago in their little dogma that goes with the treaties, which is called the Commentary on the Treaties. They said, well, you know, it's okay to have a services PE, permanent establishment clause, which is in Indian treaties. It's okay to say that if somebody's going in and doing business and doesn't have a car plant and doesn't have a big extensive physical operation, that they're taxable. That's a huge admission. It was done to placate India. India and China are such big players in the world economy that the OECD, which is a little club of rich European countries with the United States, can't ignore them. They are very aggressive about asserting tax jurisdiction. They are leading the charge. You know, now, can they single-handedly help, you know, defenseless smaller countries? No, but defenseless smaller countries can follow this example and start working in this direction. And that's where the positives come from. You get, I'm being gone. That's where the positives come from, and that's where we have to, you know, look forward. So I'm actually within my time.